Good day, fellow investors. Let's update on our quadrant and see what are the best risk and reward stocks to buy out there now for January 2025. For those who are not familiar with the value investing risk and reward quadrant, we have the reward on the x-axis from low to high and the risk on the y-axis from high to low. So what is considered a buy goes in this part of the quadrant versus a sell in this part of the quadrant, because the goal of value investing is to find low risk, don't lose money as would Buffett say, and the highest possible reward for the low risk. And if you want low risk, you can just follow Buffett and take no risk with 30% of his portfolio in US 3-month treasuries. But let's start with the riskier part of the quadrant and then we'll slowly go towards the stocks to buy there. Now, low reward and high risk is certainly not an investment you want to be in when it comes to value investing or whatever investing, and the leader there is, for example, Nvidia. If you look at the stock price, it certainly boomed, it certainly provides a service, it certainly provides a profit, it is extremely profitable, but it is also likely in an AI bubble and enjoying that. Because I was also researching, I always do research, and I was looking at the Nasdaq 52-week lows for the end of 2024, and there is a bunch of pharmaceutical companies, but this was also interesting. I thought, how can a Bitfarm company be at 52-week lows when the Bitcoin is as high as it is now? And then I looked a little bit, so they boomed, they went bust, they boomed, and that's it. But when I was just looking a little bit curiously at the presentation, their target is to really grow and grow. And what do they use for their growth? So 92,000 Nvidia, whatever, 150,000, another 150,000. Companies like these investing in crazy schemes like Bitfarms or crazy AI, everyone is investing and there are no real profits. That is also part of this Nvidia. I'm not saying Nvidia will go and be bankrupt. I'm just saying it will likely stabilize at somewhere mid-long-term cyclical semiconductor trend. And just because it is now in the exuberant part, I think it will lead to low, mid to long-term returns, and therefore it is low reward, high risk. I also looked a little bit at the others there, L'Oreal, Tesla, things like that, Microsoft, very, very expensive, and therefore I don't think I have much value to add there. We can discuss the expensiveness there as much as we want, but I've decided to just clean up a little bit the quadrant, which is also an interesting process that will go on through this video. Now, what's left? We have the Van Eck Gold Miners ETF, and we recently discussed that comparing to gold prices, gold miners are still not that cheap. So gold prices have gone up, miners flat, because they were a little bit on the exuberant side already earlier. Every video that I mention, every stock that I mention, the link to the deeper analysis will be in the description below. Apple, of course, a little bit on the expensive side. We have the S&P 500 here, LVMH also here, Diageo, things like that, Pernod Ricard, that are companies that even if they would get cheaper, it's very hard that I would invest in. ASML is a great business, but the same as Nvidia. If you track down to the consumer, then a little bit exuberant now, even if it has corrected. So I have decided to clean up a little bit of those. And here we have Nestle, that always gets me a lot of comments because people are interested and a lot of you simply want to buy it, especially as the stock is going lower. So now the P ratio is 17, dividend yield is 4, and we did a bit of analysis on Nestle, and the stock just keeps going lower and lower, and I said that at a P ratio of 15 it could get interesting, at a P ratio of 10 it could be a really good buy. And this is exactly what I mean by real investing. Now, the dividend yield is 4%, Nestle, strong brand, strong company. And the question is, nobody knows whether this will go back to 90 or 100 or we go lower to 60. So that is the risk of investing. But if you are a real investor, then you look at the dividend and the likely future dividend growth and you see how that leads to your investment goals. That is real investment. If you ask me where the stock will go, nobody knows. Then you're a speculator, a gambler. If you say, okay, I like the 4% dividend, it will lead me towards my financial goals in the next 10 years. If the stock goes cheaper, I can reinvest the dividend and build wealth through Nestle ownership. Then, yes, it is good if it fits you. If not, if you're speculating on the stock price, then you are in for more misery, as all those likely asking me on the comments are. So a little bit clean up there. I have moved Nestle a little bit more toward a higher reward, let's say from 5 to 6%, as the stock went down 14-15% since my last discussion. Now we have paper company, very interesting. We have here now a Santa Claus rally rebound for the company. There is a dividend yield, the P ratio is high. Could this be the bottom of the paper cycle? Well, if you look at this perspective, it's not much of a rebound, but at some point it should bottom and then rebound. So maybe you have still some to run to catch that rally upward. If you look at the long-term trajectory, we are securely below trend. I have looked at other paper companies, not yet reflecting that rebound. Some are much more, like International Paper, that has been up for a year and a half with great returns. And you can see here these paper ups and down cycles that are really interesting to follow. So if you want to follow that, then certainly check Meyer-Melhoff. Let me know in the comments if there are any interesting developments there, or it is just a technical stock rebound. Südzucker, we have discussed it, as with Agrana, how it is now on the cheap side, but it seems that European sugar prices are not really rebounding. However, nothing changes there since the analysis. As I always say, analysis in the link in the description below. So I'll just keep it here. And now we go to another bunch of companies, McDonald's, Nike, Schwab, Heineken, that are also still there, let's say mid-risk, mid-reward side, 5, 6, 7% returns expected. McDonald's P ratio of 25, that's a 4%. They still expect for a lot of growth, but then there it's also risky if the market suddenly requires a P ratio of 15 from McDonald's, as it has been the case in the past. Heineken is weakening and continuing to weaken. The dividend yield is there, but likely the European alcohol beverages market is increasing competition, and maybe Heineken cannot allocate the capital right, but the dividend is also not stellar, so it can also be just a interest rate game. As interest rates go higher, then the attractiveness of dividend yielding assets goes lower, and if you can get a 3% in a bank, to European investors, 2.5% might not be that attractive. We have discussed it a month ago, so not much has changed there. Now, we have also discussed Nike as a strong buy from Bill Ackman. The stock has been down on guidance and everything. The dividend yield is 2%, so again, not stellar compared to the 4% certain treasuries that we discussed at the beginning Buffett is getting. But the thing with Nike will depend on the next news with all their innovation talk and how that innovation talk will reflect Nike's top line and then trickle down to Nike's bottom line. That is something we have to watch if you want to follow Nike, and if you can understand how that will go, then you can understand also where the stock will go. For me, I cannot know how that will develop next year. It's just too expensive from a fundamental basis, and I wonder what Bill Ackman saw in the company that made him make it the biggest position in his portfolio. We have recently discussed Schwab, that is, let's say, on the cheaper side, much better dividend, 3.5% compared to the S&P 500. It is simply a better vehicle with better dividend growth, but still a dividend yield of 3.67 is not stellar. It can easily go to 5%, especially if long-term interest rates stabilize at 4%. Then we have a bunch here that is a little bit on the riskier side. I'll move later Google here, like DHL, where the stock keeps on declining slowly but steadily. The dividend yield is now a little bit more attractive there. However, I think the market is looking into more weakness from Europe, a recession perhaps, when this would then take its time to rebound. But already, if they can manage to maintain the dividend, that's already an interesting return there. Similarly, another dividend stock that has been declining is BCE from Canada, and a lot of interesting comments about it there. For now, it's stable since our analysis, but the key question is, will the dividend be cut from 10% to the, let's say, lower, more sustainable 5%? Now, Google, I've made 2 videos on Google, so how it is the cheapest of the Magnificent 7, and then how ChatGPT and other applications might take away business from Google and its search engine. Then I have moved Google from a high reward, low risk situation to a little bit lower reward and risk, and now I think the truth will be somewhere in the middle between these videos. So I have pushed Google to, let's say, a market level risk, medium market level risk, and a little bit higher reward on the cheapness and on the growth, because after all, we are still using Google and you're still watching me on Google. So thank you for that, and subscribe. I will see how this goes. It is that binary outcome, like a Google bit or something. Now, CNH Industrial, it hasn't moved much since we made the video, since David Einhorn said it is a buy. This is what usually happens when a guru says it's something a buy, then it jumps 25%, but then as media attention trickles away, it just returns to where it was before. So it is still about waiting for that food cycle to revert, for customers to buy more agricultural machines, and then see how that develops over time. Samsung Korea is getting hammered, continues to get hammered. P ratio 11, Apple P ratio 40, dividend yield 2.73. They announced some buybacks, but the stock, also traded in London, simply keeps on going down, because it is not traded on American markets likely, and that could be a thing there, but it is something interesting. If you want global exposure, Samsung is the way you can think about it. So it is here, let's say, good businesses at good returns at a fair risk situation. Now, when it comes to Dollar General, we discussed it, it keeps going down. US retail, we discussed Ulta Beauty, that has rebounded since we discussed it, but when it comes to that retail segment that looks cheap in general, I look at Ulta, it went up, Dollar General goes down, it is 10% cash flows for both of the companies, and now nailing the right one long term, it is simply too complex for me. If I would be in the United States and check personally what's going on with the retail, that would give me a better, let's say, perspective or things. Some of you send me great emails explaining Dollar General's business model and how it should also do well. So that's something that is there, but I'm going to have to eliminate, because I don't think I can add much more value than this, apart from saying, yes, the free cash flow yield is high, but I cannot see where it will go forward. Similarly, Teleperformance, the European high dividend yield, low PE ratio call center company that many think will get disrupted by AI, it's still doing well, it's looking good, but the stock is tanking, and that is, again, a binary bet on the outcome, and I don't like bets. So those bets are removed from the situation. Rubis, our oil energy distribution business, the dividend is there. Keep in mind French taxes on dividends, so not as cheap as it can be, but on the cheap side here, and that's why I have put on the buy side of the quadrant. Nutrien, weakness, the weakness continues a little bit there, but the dividend yield is also interested, and as the fertilizer cycle moves, you can watch it. Archer Daniel Midland, recent addition to my diversified portfolio, so I own this. I also, just for disclosure, own Nutrien, Rubis. I have just written a 30-page report on Archer Daniel Midlands. You have here also all the other stocks. I can give you the idea here on YouTube, but if you want the implementation, then I cannot give you more. You have everything on the research platform, and there is a 21-day money-back guarantee, so you can check it there. Then we also have Berkshire here. So Berkshire is a great business. I have put it on the low side of the risk part of the quadrant, but also on the low reward, because it is very expensive from that almost 1 trillion market cap. Buffett is not doing buybacks, which means it is overvalued from that return. So I hope you have enjoyed this. I think it gives a great perspective on the risk and reward, which is the key for building wealth over time, and that's why we are here. Next month, many more stocks to come. So I hope you enjoyed this. Link in the description below. Check my research platform. I'll see you in the next video.